So today I'm going to talk about practice question 5, International Asset Pricing Model. By the way, if you have any questions, you can just ask your question using chatting window, or you can just speak directly to me. So first of all, let's talk about part 1 questions. Explain the concept of this size and value premium as a CAPM anomaly. How would investor identify this alpha? Let me do something here. Identify these as alpha in terms of CAPM and implement trading strategies to earn each premium. In order to answer this one, let me briefly go over the key point related to that part. So when we try to identify something as a CAPM anomaly, when you try to answer such questions, you need to start with the definition of the model. Here, the CAPM model. So what is a CAPM model? In CAPM model, so you have to write down these equations, this CAPM model. The excess return from buying and holding asset J for one period, that's the excess return, is equal to beta of that asset multiplied by market excess return. So you need to explain CAPM first. Then you have to explain how to test CAPM is a good model for certain asset. When you do that, we need to use regressions. So how do we get the regression from the model? First, remove expectation from the model, and then add alpha and epsilon t. That's what we have here, the regression model. So left-hand side, we have RJT minus RFT without expectations. On the right-hand side, we have alpha, the constant for this SHA, and then CAPM term without expectations, and then error term. So this error term means sometimes you get positive error, negative error. So we need to assume average error is equal to 0. So start with the model and write down the regressions. Now using these regressions, we can test whether CAPM is a good model or not for certain asset. Now, if you collect the historical data, excess return, and historical market excess return data, you can run these regressions. And once you run these regressions, the alpha is going to be the intercept of this here, and then beta is going to be slope, right? This is the Rm minus Rf. This is the Ri minus Rf. Now, what is the meaning of alpha? You can see the meaning of alpha by taking expectation on the regression. So if you take expectations, now we have expectation RJT. And why we don't have expectations? Normally, risk-free rate doesn't move that much. So expectation doesn't matter. So we don't put expectation here. The risk-free rate doesn't move that much, risk-free. And the alpha is this constant, so we don't have to put any expectations. Beta is the constant. Now we can take expectation in front of RMT. So once you take expectation on the regressions, this is what you get. Now, what is the difference between this one and the model? The difference is coming from the concept of alpha. Now, from these equations, the expectation of the regressions, we can write down alpha in this form. So what is the meaning of this one? First of all, this part, this is the excess return from buying and holding asset J. What you have here is if the CAPM is a good model, this should be the excess return you should earn from buying this asset. If the CAPM model is correct, the excess return from buying and holding asset J should be equal to beta of that J times market excess return. That's what we have here. So the difference between these two, alpha, is going to be interpreted as follows. This is the extra return you earn by investing into asset J, the excess return, the extra returns. So if the alpha is equal to 0, then we recover CAPM, so CAPM is the right model. If alpha is not equal to 0, then CAPM doesn't hold. So we call this as a CAPM anomaly. Now the previous question, the first question asks you to explain something as a CAPM anomaly. What I have been doing is trying to answer this question first by defining CAPM and then explain what is the meaning of CAPM anomaly. Now, we're going to talk about the meaning of size and value premium as a CAPM anomaly using this alpha. Because the alpha, if alpha is not equal to 0, that is the meaning of CAPM anomaly. So first of all, what is a size anomaly? So you need to first explain the meaning of size anomaly. Small firm stock tended to have a higher holding period returns. So instead of J, we can put a group of small firms. So if you buy a group of small firm, it will generate alpha. Now this part is important. Even after accounting for the CAPM beta risk. The meaning of this one is actually this part. Accounting for the CAPM beta risk, you should earn this excess return. But if alpha is, for example, positive, then you're gonna get, so your excess return is more than what CAPM says you should earn. So what is the size anomaly? You need to first explain this part. And then using symbol, this is the meaning of size anomaly. By a group of small firms, the alpha from that investment strategy will be positive. Now, what is the value premium? So value stock, the stock with high book-to-market ratio, tended to have a higher returns even after accounting for the CAPM beta risk. So not now, instead of J, you're gonna put a group of value firm stock. So if you buy a group of value firm stock, that strategy will generate alpha, the excess return, more than what CAPM says you should earn. That's the part here, even after accounting for the CAPM beta risk. So the using symbol, alpha value is bigger than 0. That's the meaning of value anomaly. So in the previous, in the question we are talking about now, explain the concept of size and value premium. You need to explain what that means, and you need to explain alpha of small and alpha of value are positive right after explaining the meaning of anomaly using alpha and the regressions. And then this question asks you to identify how investor to answer this one. How an investor identify this as alpha? Yeah, we already explained that. And this part, implement trading strategy to earn each premium. For that one, you need to use this one here, zero cost SMB strategy. So once you find out the alpha of small is positive by investing into a group of small firm, you earn more than what CAPM says you should earn. Once you identify then you're gonna form size portfolio. So how do we form size portfolio? So for example, if you have 100 company, you're gonna rank 100 company based on the market capitalizations, and you're gonna form 5 different portfolio. We talk about this one during the lecture, right? So 20, the one portfolio with 20, smallest one. The B means the one group of 20 firm with the largest capitalizations. So you're gonna buy S and finance it by short selling B, right? That's that's one way of exploiting this small firm anomaly. If you don't have any money, you're gonna finance your strategy by buying a group of small firm by short selling by the group of large firms. What about value anomaly? You're gonna do the similar thing, so-called HML strategy, high minus low book to market strategy. Here, you're gonna rank every firm in terms of book to market ratio, right? And you're gonna buy a portfolio of the company with highest book to market ratio. And then you're going to finance it by short selling a group of company with the lowest book to market ratio, right? So I just answered the questions. The first one, how to implement trading strategy to earn this premium. So in summary, in order to answer these kind of questions, since this question is talking about CAPM anomaly, you have to start with defining the meaning of CAPM, and then you have to explain the CAPM anomaly using the regression model. And then you need to show the meaning of alpha here. And then you have to define the size and value premium with one sentence, what is the meaning of those? And then how to implement that strategy based on the SMB and HML. Do you have any questions? So that's the first question I just explained. So if you have any question, you can stop and ask me that. Number two, explain the momentum, profitability, and investment anomaly as a Fama-French three-factor anomaly. Now, we are using Fama-French three-factor model, and we need to define what is the meaning of Fama-French three-factor anomaly. Let me use the same method I used in question one. You need to first define what is the meaning of Fama-French three-factor model, just like you first know what is the meaning of CAPM. Then we need to come up with a regression model to test Fama-French three-factor model, so regression model. And then you need to talk about the meaning of alpha in these regressions. And then you have to explain what is the meaning of momentum, profitability, and investment anomaly as an alpha. I will explain more detail in a minute. This is the overview, just following the same logic. And finally, how would you implement trading strategy? Well, you need to think about the winner minus loser strategy and the robust minus weak strategy and conservative minus aggressive strategy. So that's the overview. Let's talk about that step by step. So in the second review slide, what is Fama-French three-factor model? Well, this is so-called alpha become beta. So the previous two puzzle size and value premium, value anomaly now become the factor in this APT model. So what you have in the left-hand side is the excess return from buying asset J and holding that for one period is equal to CAPM beta time market excess return. So this is CAPM term plus sensitivity to SMB times the excess return from buying and short selling the SMB. So by exploiting size anomaly, you can implement this strategy. The return from that strategy will be a factor in Fama-French three-factor model. H is a sensitivity, just like beta. So S and H are like a beta. The covariance between each asset's return and the factor return. It's a market access return or SMB return, in this case, HML return. So this is Fama-French three-factor model. Then I explain how to get the regression model. You need to first remove expectations here, 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 and then you need to add alpha, and you need to add epsilon t. That's a regression model. That's what you have here. The left-hand side, you have excess return, the real return, plus the alpha, and plus the beta and market return without expectations, S without expectation, H without expectation, and error term. Just like before, error term could be positive or negative across time, but on the average, this should be equal to 0. That's our assumptions when we run regressions. Once you get this regression form, then we need to think about the meaning of alpha. How do we get the meaning of alpha? Now you take expectation of the regression. The left-hand side, we have expectation of RJT minus RFT. Like before, the RFT doesn't move that much, so we don't put expectation here, and this is also risk-free, so it's already given to you. So without expectation, the RFT is given like this. and alpha is intercept, so just constant, so we don't need expectation here. Beta is a constant, S is constant, H is constant. Now expectation of error term goes to 0, so there's no error term here. And then we have ERM. There's no expectation for RFT, just like this. An expectation on SMB and expectation on HML. If you compare this form, the expectation on the regressions with Far-Fetched three-factor model, you will find out alpha. If alpha is equal to 0, this is just the Far-Fetched three-factor model. If alpha is not equal to 0, then something is wrong with the Far-Fetched three-factor model. Now, let's talk about the meaning of alpha more precisely by moving all this term to the left-hand side. Then alpha is equal to, well, I put parentheses like this. So the meaning is, this is the average return from buying and holding SHA. This is the return, not excess return, because this is the return. This is the return you should earn if Far-Fetched three-factor model is the right model. If this one is bigger than this one, that means alpha is bigger than 0. So when the alpha is equal to 0, Far-Fetched three-factor model satisfied. If alpha is not equal to 0, especially if this is positive, what is the meaning? The return from holding SJ is bigger than what Far-Fetched three-factor model says you should earn. We call that as the Far-Fetched three-factor anomaly. So I just explained the second question, these questions, by stating what is the Far-Fetched three-factor model and what is the meaning of anomaly using regressions. Then we need to talk about momentum profitability investment anomaly as a Far-Fetched three-factor anomaly. Then we're going to talk about how to implement this strategy. Now you see that I'm following exactly the same structure I used for question 1 in question 2. Only the models are different. Other than that, the structure is exactly the same. Let me talk about that one by one. First, you need to explain what is the meaning of momentum anomaly. So we find from the academic research, past winner tended to have a higher holding period returns. This part is important, even after accounting for the Far-Fetched three-factor risk. That's the part here. Even after accounting for Far-Fetched three-factor risk, you earn more than what this part. The return from buying past winner, you will generate X more return than what Far-Fetched three-factor says you should earn. What is the profitability anomaly? So we're gonna rank the firms in terms of profitability. And if you buy a group of profitable firms, that strategy will generate higher returns even after accounting for Far-Fetched three-factor risk. Investment anomaly, if you buy a group of low investment firms, that strategy will generate higher holding period returns even after accounting for Far-Fetched three-factor risk. Even after, this one, all this one says, by implementing momentum profitability investment strategy, your return will be more than what Far-Fetched three-factor says you should earn. So I just explained how to talk about momentum anomaly. You first define what that is, and then you need to talk about that in terms of alpha. So if you put the momentum instead of J, the alpha on that momentum should be, the alpha on the winner should be positive. So again, if you buy a group of winner portfolio, they will generate alpha. They will generate more than what Far-Fetched says you should earn. You can talk about the same thing on the robust firm and conservative firms. Now, finally, how would you implement the momentum anomaly? You need to do zero cost winner minus loser strategy, how to exploit profitability anomaly. You have to implement a robust minus weak strategy. How would you implement investment anomaly? you need to conduct the conservative minus aggressive strategy. So I already explained, but let's talk about this one a little bit. How would you implement winner minus losers? You need to rank all firms based on the past performance, return performance. So you're gonna form 5 portfolio. So let's say you have 100 stock, just like what we said during the lecture. You have 100 stock, then you form 5 different portfolio. And let's say the first one is the 20 portfolio with the highest, the lowest past performance. So this is the loser. And let's say the final one is the group of 20 portfolio with highest past return performance. So this is winner. Then you're gonna buy the winner portfolio and you're gonna finance it by short selling loser portfolio, right? The return from that strategy will be expected value, average return will be expectation of the winner minus loser, right? So you're gonna implement this strategy. Likewise, you can talk about how to implement RMW CMA strategy in the same way. So what I have been explaining is, if you get the question like this, your approach should always define the model, talk about the regressions, talk about the meaning of alpha, then talk about the meaning of each anomaly, and using the alpha to talk about that more precisely, finally talk about how to implement that, right? Now, let's say I give you something like a new anomaly nobody know before. You discovered a new anomaly. Then how would you explain whether that is a new anomaly or not? That's the actually. So I'm going to skip question 3 for now and go to the next one. Then we will come back to question 3 later. That's the question in part 2. So let's read this one first. Let's say a quant in your company have developed a new zero-cost investment strategy, something like SMB, HML. So what I mean by that is you buy a group of certain firm by short selling a group of certain firms. That's the zero-cost investment strategy. In U.S. stock market, based on some innovative use of historical accounting and stock data. So basically, this quant develop a new way of ranking firms. And he has a very good story and would like to claim its potential to you. You are the head of the active investment, the hedge fund. And in your brain, you think the Carhart model, the 4-factor model, is a good asset pricing model. When do you wish to invest in this new strategy? What is the meaning of this one? This means you need to check whether this new strategy is generating alpha or not. So whether what we found is a new anomaly or not. When you think about new anomaly, just like what you think about the size anomaly, value anomaly, these 3 anomaly, you should have some benchmark. In this question, I gave you the benchmark CAPM. In this question, I gave you the benchmark Farber-Prince 3-factor model. If I don't give you Carhart model here, what you need to do is first, you need to think about which model could be a good benchmark model. You need to set that benchmark model by yourself, given this scenario. Okay? Well, here, let's say we use Carhart model. So what is the Carhart model? Let's go there briefly. The Carhart model is basically is another incident of the alpha become beta. Here, momentum, the alpha, the Farber-Prince 3-factor alpha become new factor. So for this part, this is Farber-Prince 3-factor model. We just add winner minus loser, the excess return, as a new factor. So WJ is the sensitivity to winner minus loser, just like H, S, and beta. And E, this is the average return from implementing winner minus loser strategy. That's a Carhart 4-factor model. What is the Farber-Prince 5-factor model? Here, they ignore winner minus loser, but they include robust minus weak, and conservative minus aggressive as a new additional factor. This is another incident of alpha become beta. Now, some people use so-called Farr-French 6-factor model. That's the Farr-French 5-factor model plus this term, W minus loser. Somebody called that a 6-factor model. Then, if we are thinking about the anomaly in the US market, so you are a US investor, you are thinking about anomaly in US market, and you need to determine what is the benchmark model. The possible candidate will be CAPM, Farr-French 3-factor model, CART 4-factor model, and Farr-French 5-factor model. You need to choose one benchmark first by yourself if you get this kind of questions. So the quant in your company says he find a new anomaly. Then what is the anomaly? You need a model first, benchmark model. Somehow, let's say you think CART model is a good asset pricing model and you're gonna use the benchmark model. Then how would you approach this question? How would you answer this question? First, define the benchmark model, just like what we did before. First, they explain the benchmark model and think about the regressions and think about the alpha, and then, right? We do the exactly same thing here. So we write down benchmark model, CART 4-factor model. And then how do we get the regression form? You remove expectations, add alpha and epsilon t, and you add these assumptions, average error is equal to 0. Now, if alpha is equal to 0, then if you take expectations, it will go back to the CART model. So what you said is the CART model is correct. This is a right model. What is the meaning of that? The meaning is if you implement this strategy, if you earn excess return from implementing this strategy, there is no alpha, which means what you earn is still something CART model says you should earn. There's no extra returns. Your return from buying this new strategy is just the coming from already the well-known premium in the literature. For simplicity, let's assume this case, beta SH is equal to 0, WJ is equal to 5, and the expectation of winner minus loser from historical data is 66%. And let's say this guy says he could earn 30% return by implementing this strategy. Looks huge, but if alpha is equal to 0, then you have 30% here. Every term is equal to 0, including alpha, 0, 0, 0, 0. This one is 5, this one is 6%. Average sense this is equal to 0. Then what is the meaning of this? You earn 30% because you are investing winner minus loser, and the sensitivity is 5 times. So whenever winner minus loser goes by 1%, you lose by 5%. That's the meaning of sensitivity. In other words, your new strategy is nothing but winner minus loser strategy with some leverage. Same, so something happened to winner minus loser, you lose by 5 times more and you earn by 5 times more. It's a leveraged strategy. Then this is not a new strategy. So you're not gonna buy, you're not gonna accept this one as a new strategy for your hedge fund. But let's say you find alpha is 25% and not explained by any other things like this. Then this is something unexplained by the model. This is something you will earn more than what your benchmark says you should earn. So you're gonna implement this strategy. Now, if you think about this, if you understand this whole step, you may be able to ask the following thing: what if the CART model is not a right model? Then, even though you find alpha here, that may not say that you can find alpha if you use something like Farr-French 5-factor model. What I'm trying to say is that you need to set, this is too difficult. You need to set what should be the benchmark model. So if I get this kind of question in the exam, you have to start by selecting your benchmark model very carefully. We talk about a similar case during the lecture. here, hedge fund advertise they have been very successful by generating 30% returns. In that example, we also used CART 4-factor model. So now you can see the resemblance. We do the regression here by removing expectations, by adding alpha and error terms, by assuming this one. Then we have two different cases. If alpha is equal to 0, that means I explained this one. What this hedge fund is doing is just the winner minus loser using this simplified example. And it's just the leveraged one. If you find alpha is 25%, that means this hedge fund is doing something you don't understand. So maybe you need to take part, buy some asset from this hedge fund. So what I'm trying to say here is when I ask you to explain new alpha, the new strategy or hedge fund strategy, and we want to know whether what they do is the really new things, the newly developed one, we need to always follow this approach to think about that issue and think about the meaning of alpha. Okay. Now this for the domestic case. The question 3 here, well, we're going to talk about this one this Thursday, but you can see the resemblance. You can just I will give you a summary of this model right away. Then you will see. Well, actually, you have already learned most of it by studying domestic model. So what I'm trying to say here is that now we are assuming you are investing in international market. And you will see there are size premium, value premium, and momentum premium, even profitability premium, investment anomaly, even in international stock market. So what you learn in US stock market is not the unusual things. You will find similar anomaly in international investment too. So let's say I ask you to explain the concept of size and value premium in international stock market. How would you approach that? You need to first start to talking about the benchmark model. Then you cannot use US domestic model, US CAPM or Farm French 3-factor CAPM. What should be the model you need to use? Right? What should be the benchmark model? Then you need to think about the regression based on the benchmark model. It's the same structure. Now, previous class, we talked about several international model. The first one was the world CAPM. So this is just CAPM model. It looks like CAPM model. Only one difference is this one. Now your market portfolio is not in US investor case, US market portfolio. Now you should use world market portfolio. Consists of the all important asset in the international stock market. So beta JW is the sensitivity of each asset with respect to the world market portfolio. So world CAPM is just a CAPM, just replace domestic market portfolio with world market portfolio. Now we need to assume something to use this one. We need to assume fully integrated market. What is the meaning of that? For example, as a UK investor, you can invest in any international stock market under fully integrated market assumptions. So you can invest in US, French, China, in all kinds of market without any restriction. Then world CAPM is the right model. We also need to assume the following things. There's no premium for taking currency risk. Well, this is only true when relative PPP hold. And you use the real return to think about your financial decision. So fully integrated market, no premium for taking FX risk. Under these assumptions, you could use the world CAPM as your benchmark, just like what you use the domestic CAPM as a benchmark for size and value, right? Obviously, world CAPM is not a good model because we find size anomaly, value anomaly, momentum, profitability, investment anomaly all over the place. So obviously, there should be the extension of Farm French 3-factor model, CART 4-factor model, and Farm French 5-factor model in the international market. That's something you're gonna learn later on. But This is just simple extension of the domestic model. I just put global, global, global in front of Farn-French three-factor, CART four-factor, Farn-French five-factor model. If you just take a look at model itself, model looks like exactly same. What is the difference? Now, instead of domestic market portfolio, you use world market portfolio. Now, instead of use SMB for example, US stock market, now I put G. G means global, which means when you compute SMB, you use global stock, not one country stock. When you compute HML, you use global stock. When you compute winner minus loser, you use global stock. When you compute RMW, you use global stock. When you compute CMA, you use the global stock, right? So this is just a simple, very simple extension of the domestic model, just replacing the stock, the domestic stock with the world stock. Now, I told you, when can we use World CAPM? Fully integrated market, no premium taking FX risk. That's also true for this guy here. We still need the same assumption. What if that assumption is wrong? If markets are not fully integrated, first of all, we can think about CAPM with partial integrations. This is the Baker-Harvey model we talk about. Why markets are partially integrated? Because the investor, domestic investor, you hate to invest into international market because the international market are not familiar to you. You're not familiar with their culture, their language, their report. So psychological barrier, or sometimes because of legal restriction, you cannot invest into international market. Sometimes you are worried about high transaction costs. You worry about higher tax you have to pay. You are worried about political risk, especially if you invest in emerging market. And you also worry about currency risk, right? So because of these kind of reason, maybe markets are not fully integrated. In that case, for the CAPM, we can think about weighted average model. So what is the weighted average model? So here the excess return from buying asset J is equal to, first term is world market term, the world market term. Second term, here L is for local or domestic or each country. So what is the meaning of these equations? If WT is equal to 1, then this second term is 0. You only have the first term. That's a world CAPM. WT is equal to 1, that means fully integrated market. If WT is equal to 0, then this term is gone. You only have the second term. So what is the second term? This is the domestic CAPM. So this is a fully segmented market. The intuition is important. In a partially integrated world, the model you're going to use is the mixture of the global factor, world market portfolio factor, and local market factor. That's the CAPM case. What about the APT case? We have to use also weighted average of the global factor and local factor. Farn-French three-factor model, you have a CAPM, world CAPM term, global SMB, global HML. That's for the global factor, just like world CAPM here. Here, L means the local factor. So this is local market portfolio. This is the local SMB. So you construct SMB using local stock only. For US case, you use only US stock to compute this one. You used only US stock to compute this one. You only use the US stock to compute this one. If you're a UK investor, you only use the UK stock to construct this one. UK stock to construct this one, right? Anyway, and this is beta here, weight inside this beta. So what we have here is the weighted average again. So the idea is exactly the same as before. If in the fully integrated market, we have global model only. In a fully segmented market, we have local model only. Just like that, in a fully integrated market, we have only global Farn-French three-factor. In a fully segmented market, we only have a segmented factor, the local factor. In a partially integrated market, we have all factor. Just like that card four-factor model, hybrid is also four-factor consists of global stock, four-factor consists of the local stock. Far-French five-factor model, hybrid one, 5 global factors, 5 local factors. So this hybrid model is just like this case. The CAPM, if in a partially integrated world, we should use this weighted average of the global and local. In a weighted, the partially integrated world, we have to use this APT model, just like this. Okay, so, and then another one is in so-called international CAPM. So this part is for the integration part. This part is for the FX risk part. If you think you should ask compensation for taking currency risk, then we need to ask a premium for changes in exchange rate. I explained the meaning of this one, right? The meaning of this one in terms of US investor, you're gonna borrow dollar, convert, invest into certain currency 1 to currency K. In the lecture, I used the example of SRP, the pound. So you borrow dollar, convert dollar into pound, you put pound into pound money market. After one period, you're gonna convert that back to dollar. The return from that is SRP. The excess return we studied in topic 2.3. Anyway, so let me summarize this one again. In an international market, you can start with the world CAPM, just like we start with the domestic CAPM for domestic case. But world CAPM has two important assumptions: fully integrated market, and then no FX risk, the no premium for FX risk. If this assumption is not correct, if fully integration is not correct, then we can use this hybrid weighted average model. If you ask premium for taking currency risk, you have to use international CAPM. However, we also find out there are size premium, momentum, value, profitability, and investment anomaly. So you shouldn't use only CAPM or a variation of CAPM. You need to use a variations of APT model. In a fully integrated market, you can use this global model. In a hybrid market, you can use this one. Now note, what about if you suspect RPPP doesn't hold, relative PPP doesn't hold, then you can add currency premium to this model. You can add currency premium to this model, based on this international CAPM. What I have been explaining is the kind of benchmark model you could use when we think about alpha in terms of international market. So let's go back to this question 3 here. We want to explain size, value, momentum pattern in international average return. Well, Far-French three-factor model, this paper starts by using world CAPM, just like the question 1. And they identify size and value premium and momentum premium, the momentum anomaly using world CAPM. How would you do that? So first define world CAPM, and then define regression based on world CAPM, and define the meaning of size and value momentum. Because now this is about international market, you need to form these 3 using global stock, and you need to explain that in terms of alpha, right? So that's Far-French three-factor model. And then they develop three-factor model, Far-French three-factor model, and the Carhart four-factor model based on the new anomaly, just like what we did before for domestic case. You first start with the CAPM, you find size and value anomaly, you add those as a new factor, right? So this Far-French, the 2012, just extending this idea to international setting. They find size value, momentum anomaly, and they discuss world CAPM is not a good model. You need to add more factors, just like a Far-French three-factor model in international setting, just like a Carhart four-factor model in international setting. Now, the Carroll and Wu, I'm going to talk about this one more precisely this Thursday. Let me give you just one hint, one note. Carroll and Wu use hard four-factor model, the same model, but they define something called investability restrictions. This is about what is the meaning of global stock? So which stock should be included when you compute G? Any stock in the world, China stock or Hong Kong stock, or even some third country, the country stock, do you need to include everything or do you need to include certain things? They claim when you compute global stock, global portfolio, global factor, you need to use only the stock globally accessible stock, which means this stock should be listed in US, UK, Singapore, where anyone in the world can freely buy and sell stock there. So globally accessible stock. You cannot include certain stock, even though that stock is traded in certain country. If, as an international investor, if you are not able to buy that, that shouldn't be included into this global stock, right? Because that's not global at all. It's there, but it's not global. You cannot buy that. So they define something called globally accessible stock and locally accessible stock, and they come up with a new way of computing factors. So what they find is once you compute factor like this, hybrid model is a very good model. Far-French model says hybrid model is not a good model. So I'm going to provide more explanations this Thursday. Anyway, so what I'm trying to say here is the next questions. This one. Kim Deal, an equity researcher working at AM-Best hedge fund in New York. Now you are working in New York, and you develop a new way of measuring earning potential of 100 company in China. So we are talking about international investment. Using historical data, Kim Deal formed 10 portfolio based on this earning potential, construct a zero-cost portfolio, high minus low earning potential, and find spectacular dollar average return on HMLEP. And he says, this is a new strategy. We need to use it. Let's say you are the head of the hedge fund, and Kim Deal is the researcher under your supervisions. How do we know whether this strategy is a new strategy? The question is something like this one. Want to develop new strategy based on US? You should think about the benchmark, and then you have to come up with a regression, right? We follow the same strategy. Only difference is now we are talking about international investments, so your benchmark should be international model, not Carhart model. Here, I give the explanation based on Carhart model because I don't want to spend more time to talk about, because I want to use the same model like this one here. So using Carhart model, you can think about the regressions and you can think about alpha. However, this is very bad model. The benchmark should be the good model. Then when you try to answer these kind of questions, you should think about which international model could be a good benchmark model. First of all, if you find this new strategy, valuable strategy for UK market, maybe using global model, where is it? Using global model may not be a bad idea because US and UK are fully integrated maybe. But if you suspect maybe relative PPP doesn't hold between US and UK, then you may want to add some currency risk premium, just like this one in your model. That could be your benchmark model. But in this case, in this special questions, we are thinking about 100 company in China. Now, when you think about China, maybe Chinese stock markets are not fully integrated with the world market. Then perhaps hybrid model could be better benchmark model. Then you need to come up with one of these model. And if you suspect RPPP doesn't hold, you can also add the currency risk premium part here. So when you approach this kind of question, first, write down benchmark. based on the question you have and based on some thinking of yourself, just like what I said, UK maybe fully integrated, whatever, China maybe partially integrated, whatever, you need to write down benchmark model. You write the regression model based on that benchmark model by removing expectation, by adding alpha and epsilon t, and then explain the alpha things, just like something like I did here. So case one, case two, so simplifying things like this. Do you have any questions? So that's the answer for two. Part two, the final one is about the case study, smart beta, exchange trade fund, and factor investing. These questions are just by definition questions. The first one, what is the meaning of factor investing? Now you are buying for example, SMB group of you're implementing SMB strategy, buying a ETF on SMB, buying ETF on HML, buying ETF on winner minus loser. What I'm trying to say is that the factor investing is you're investing factor into factor itself. You're implementing that strategy, the well-known strategy based on the academic research. That's so-called factor investment. What is the difference between factor investment and traditional investment? Traditionally, we talk about the asset allocation across different asset class. So you put 30% into stock, 40% into bond. Factor investment says you need to do that to factor itself. So something like you put 30% to the market, 20% to SMB, 10% to winner minus loser. That's a factor investment. You directly put asset allocation to factor itself, because factor generate persistent return for you. That's a factor investment. It's different from traditional investment. So what you can actually do practically is to choose the factor, SMB, HML, whatever you believe in for the long-term performance. You think the winner minus loser buying that one is good, then choose that as one of the factors, and choose that as one component in your portfolio. That's the factor investment. Second one, smart beta ETF. So buying ETF on factor is so-called passive or active. What is the meaning of passive and active? So passive historically mean you just buy an ETF on market index. You don't do any research. You're lazy. You're just buying on market. You don't do anything else. That's the original definition of passive. Active, you do research, you find the buying certain stock is profitable, then you buy that stock. If your research says buying this one is good, do buy that stock. If your research says selling this stock is good, then you sell that one. That's the active investment strategy. Now, smart beta ETF, buying ETF on factor, is both passive and active. First of all, it's active because it's more than just buying an ETF on market index. It's based on the academic research. So you are reflecting what academics find out from the last 30 years of research. So it's active in that sense. However, once you choose to buy an ETF on factor, then it's passive because you don't do any more research. You just choose factor based on previous academic research, active, but after that, you just leave it like that. So it's a passive approach. So both active and passive. Finally, what is the multi-factor ETF and why we use it? So if you read this case study, you will find more information about this one. In the factor investment era, you can form a portfolio of factors, something like you put 20% to buy an ETF on SMB, you put 50% of your wealth to buy an ETF on market index, right? You can do this. So you can form a portfolio of factor itself. Now this BlackRock, they try to introduce so-called multi-factor ETF. So this one is kind of doing the similar things, but they are doing it more efficiently, and they are doing it based on their research. So if you buy just one ETF, this ETF will be a portfolio factor. So you can buy ETF on each factor, and you can form a portfolio by yourself. That's one way of getting this the factor investment, portfolio factor investment. Or BlackRock construct a portfolio factor by themselves and sell ETF from that. That's so-called multi-factor ETF. Well, normally they have a better way, the cost-effective way of forming a portfolio. It's more expensive if you do this one by yourself. They are always better, they find a better way to do this one, cost-effective one. Also, they may get the portfolio weight on each factor based on their research. The 20% or 50%, how do we choose portfolio weight? There should be some optimal way of doing this, right? This multi-factor ETF can reflect that based on their academic research. So they were thinking about introducing multi-factor ETF when this case study was done. And actually nowadays, multi-factor ETF is available in the market. So if you click this URL, you will find more information about that. Okay, so that's the practice questions on topic 5. So I almost to review all the key points, and I provide all the answer to practice questions. Do you have any questions? So you should learn a way of thinking. When somebody says, I got a new strategy generating huge return, when somebody says, I am a successful hedge fund manager, how do we know? So there should be a way to test that kind of things. You have learned a way to test that kind of things using benchmark model, regression model, thinking about alpha, etc. And the important thing is finding a right benchmark model. If you find a right benchmark model, after that, it's almost automatic.